Hello, guys. Good afternoon, good morning, good evening, wherever you are in the world, and welcome to another episode of How to Trade Successfully with Less Than $5,000. My name is Rony Nehme. I am Chief Market Analyst at SquaredFinancial, and this is episode 10, the final episode, the finale. Hope you'll have fun. If we have time, we'll do a little bit of trading at the end, as I promised, and just to make it a little bit more exciting. And that's it. Let's start. Is everybody here? Everybody can hear us and can see us fine? Is all tech problems? I had a few. The first few minutes I solved them. Okay, so everything's fine. Seems like everything is fine. Does anybody hear me? Everybody hear me? Okay, so I'll share my screen. Let's start with without further ado, with the presentation. Okay, so this episode we're going to, of course, do some live trading, but also talk about very important stuff. First off, we're going to discuss beginner's luck. Okay, you all are going to start trading very soon. If you haven't already, fund your account, trade with live money. So you're going to most probably have to deal with beginner's luck. And beginner's luck is just a phase in the beginning. It doesn't really mean that you might make money, you might not. It's not really the term. However, it has to deal with the phase that you go through, whether you make money or you lose money, understanding how experience will help you get through that stage and understand how the markets function. We already did how the markets function. Today is more about understanding the way it works with live money, live funds. Okay, so let's start with beginner's luck. There's a fundamental lesson that every single trader has to learn prior to starting their trading journey, and that's experience counts more than any other factor. And when I talk about experience, I'm saying experience trading many instruments and asset classes, experience in analyzing fundamentally and technically, in researching, in having the right mindset, in the psychology of trading, in understanding emotions, experience in controlling your anger. So all these phases that we go through, especially in the beginning, different people react to different things differently. So it might take you 3, 4 months, 6 months to understand how to deal with these emotions from an experience perspective. Also to understand how to deal with risk management or the lack thereof. Sometimes we are very strict in our rules in the beginning, and then we start, relaxing a little bit as we see that, wow, okay, this is not as hard as I thought. Why? Because the market hasn't changed yet. And this is a very important thing that we learn with experience. So experience in risk management, etc. Okay, so you will only get better and better when you constantly evolve and experience new types of markets. So if you haven't traded live yet, okay, you must accept that you don't know anything. Because if you've traded on a simulation and done some back testing for as long as you want, all these things that affect your mindset, you didn't deal with them yet, and the experience you haven't gotten yet. So you don't know anything. You have to accept that. So being active in bull markets, bear markets, low volume markets, volatile markets, not moving markets, all kinds of markets, you have to experience them all, or at least be aware of them and try to adapt. Okay, Because by trading live with real money, you will experience all these things, especially the psychological aspects, the experience of losing money, but most importantly, the experience of making money, which is why I called it beginner's luck, because there's nothing more dangerous than making money in the beginning. We all like to make money. We love it, right? But there is nothing more dangerous than that. Why? Because I've noticed, unfortunately, time and time again, that with many people I know, with the clients, with traders, with some of my students I coached, I trained, that the reason is because they underestimate the power of the market. And the biggest mistake that many traders do, including myself when I first started 19 years ago, okay, the failure is, or to refuse, not the failure, but to refuse, because it's all in our mind, right? To refuse to adapt to these changing markets, okay? The bull market, the bear market, the bull. And it might seem easy when you read it here on my slide, being active in bull markets, bear markets. Okay, I've experienced bull markets, I've experienced bear markets, I've experienced sideways markets. However, you have to understand that the type of market can last for months, maybe years, but eventually when it changes, if you're not ready, you can get wiped out. And you can get wiped out money-wise, or you can get wiped out psychology-wise and just leave the business and say to yourself, this is so hard, this is not for me, this is a scam, this is a bullcrap, this is not, this is not something that I want to do for the rest of my life, or at least on the side, in addition to my current job, in order to, create wealth with time. Okay, so the reason is that most people underestimate the power of the market, and the biggest mistake that many traders do, including myself, like I said, okay, because the market never stops changing. In almost 20 years of trading, I don't know if I've told you this, but I haven't seen the volatility, for example, okay, that we are witnessing today during this pandemic. Okay, and many of the moves seem illogic, but one of the things experience teaches you is that most of the times the market doesn't make any sense, and you just have to deal with it and to adapt. The faster you adapt, the better. Okay, and if you don't make money, or you stop making money if you've been making money for some time. I don't know whether I also told you this story, okay, but when I first took my first trading course in February 2001, okay, by May 2001, I was positive for the month. So I was starting to make money. I had discovered my style. I was finally consistent. We talked about consistency, and I had, finally discovered consistency. In June, okay, so 3 months later, I made a little bit of money. But in July 2001, I got my first big paycheck, okay? And that monthly pay was bigger than my whole annual salary when I was, in my previous job as a banker. Okay, so you can imagine 2001 was a great year for me. 2002, even better. 2003, woohoo! 2004, I was a king. But in 2005, something changed. Maybe it was the introduction of algorithmic trading, all these HFT, high frequency trading, computer trading that investment banks introduced on the markets, or started, these things started to evolve and started to become better and better, and started to take a lot of market share. So most of the volume was now computer related volume. Okay, that started around 2005, 2006. So 2000, maybe, now that I think of it, maybe that was the reason the market changed. It became much faster than I had, that I was used to for so many years, for 4 years. And so I did not adapt to this change. Okay, it doesn't really matter what the change was, as long as you adapt. The point is, I refused to adapt to new market conditions. Okay, and it was frustrating. I got so used to my own style that I convinced myself that there was something wrong with the market and not with my own trading. Okay, so that's what happens a lot. And this happened to me a few years after, but it was still all these years, to me at least, the 4 first years were beginner's luck, because the market was trading in a fashion that I got used to that and started making money or taking advantage of this type of market. Okay, and when the market changed, and it doesn't matter what the change is, because it will come, and you can't be stubborn like I was. Okay, I didn't understand. I was angry, and it took me 2 bad years to understand that the market was not wrong, that I was wrong. So 2005 and 2006, I practically didn't even break even on my expenses. So I was now, spending from my savings, or the 2005 and 2006 were my worst years in terms financially speaking. Okay. And so I had to start from the beginning. I knew that it was my fault after some time. I didn't adapt right away. Good traders adapt right away. Good traders are humble and know that this is the power of the market. It changes. I have to adapt to it. I have to reshape myself to adapt to it. Okay. So where were we? So, so the quicker you adapt, we know that now, the better. And of course, every time I tell this story, most students or most clients that hear me say this story, they say, no, it doesn't matter. I will adapt, faster now that I know, etc. That's what is called, that's what I call false confidence. And you will experience this in your early also stages if you haven't already. And if you already are a trader, then you know what I'm talking about. Hold on a second, I think someone asked a question. We will leave questions till the end, or no, if you have questions, please feel free. Okay. Okay, yes. So I started in February 2001, the training, okay, just to answer Aso's question. And it was by May that I made my first, positive month. However, in June, I made a lot of money, and that was that was the breakthrough for me. Okay, I had found my style, I had found my way, my strategy, my way of trading. Okay, and just to continue what I was saying, that the quicker you adapt, okay, the better. And for example, I'll give you another example. Someone who's making money in a bull market, okay, was making money in a bull market. So you buy, you sell, and a lot of people were doing that. Retail traders were doing that now in tech stocks and the NASDAQ index, right? So you buy, you sell, you make money. Whatever you buy on a bull market, eventually price goes up, right? You will sell. Even if you buy and it goes against you a little bit, you just wait, you're frustrated, but then it's a bull market, right? So the market goes back up and you make money, okay? So eventually what happens is you develop a sense of false confidence, okay? False confidence. I'll explain what negative reinforcers is, because also very important. But false confidence, you have to be aware of it, because false confidence will get you to say things like, why is this happening? Why is the market going up when it's supposed to go down? Or the opposite, right? The market changed. It's no longer a bull market. You're still buying, but it's not going up anymore. Or even worse, you bought and then the market dropped a lot, and now it's trading sideways in a channel, and your entry level is up there, and now it's still, you can still make money by buying low and selling high, or the opposite, because it's trading in a sideways manner. For sometimes it lasts month, for sometimes in the summer we have low volume, so much unlike this summer. This is an exceptional year, but usually summer has extreme low volume. That there's a saying that says, sell in May and go away, right? Sell in May before the summer and go away. Don't trade, because there's so much low volume that any big buyer or seller can move the markets, and without making any sense. Just they want to get out of a position or enter a position. So sometimes moves don't make any sense and seem illogic to us. Okay, so false confidence, you will say things like, why is this happening? Why is the market going up? It's supposed to go down. This doesn't make any sense. Please, I hear this every day from very experienced traders and investors. I hear, this doesn't make any sense. Okay, well, it doesn't matter. because the market is always right. Even when it doesn't make any sense, the market is always right. So please write this down. Rule number 1, the market is always right. You have to remember that. And there's another rule number 2. If you ever hear yourself say, this doesn't make any sense, remember rule number 1, the market is always right. Because sense and logic don't drive markets. Supply and demand do. And supply and demand are driven by people's psychology, not what you perceive or what I perceive as logic or illogic. So please remember, the market is always right. Every time you see yourself arguing or saying, being frustrated or angry at a position that's not working out for you, remember the rule number 1. What is it? Joe says invest with the Fed. That's correct. That's maybe rule number 3. So good rule, Joe. Also write that down. Never fight the Fed. That's a good rule, especially now during all the stimulus, etc. Never fight the Fed. So the rule number 1, whether the Fed injected money in the market and that's why it's going up, but you don't understand, it's not supposed to go up. It doesn't matter what you think. Why? Rule number 1, okay? So even if it doesn't make any sense, never argue with the market, okay? It's like when I argue with my wife, okay? She says things that don't make a lot of sense sometimes, and she's going on and on and on. Nothing seems logic to me, but you know what? She's always right. And once you understand that and accept it, you'll be at peace. I'm not talking about my wife anymore. You'll be at peace and you'll become a good trader. Okay, so let's move on. Negative reinforcers first before we go to the another slide. Negative reinforcers, what is it? And I want to please tell you this. These webinars are good. Why? Because I'm trying to transmit my knowledge to you, my experience to you. So as we said previously, discussed in previous webinars, there aren't any magic formula. All I can teach you is what not to do and what try to do. You will all have to go through the learning process by yourself with your own money, because that's how it works. I've done this so many times, and people always think they're better than the rest of the market participants. They're better than the rest of the group. It's an ego problem that every one of us has. It's good to have it, as long as you understand it and you know that there's a limit to it. So don't think you're a king like I did in 2004. But negative reinforcers are when, let's say, I'll give you an example. Let's say you are in a position and you have a stop, okay? So you have a plan. You say to yourself, okay, I'm going to go long. I'm confident enough, but I will put a stop anyway. Okay, so I'm confident this is a good trade, a good strategy. I'm not fighting the market. Everything seems fine, theoretically from a fundamental and technical perspective. I'm following my rules. I have a stop here in case, right? The worst case scenario. And then something happens in the market. I don't know, Fed Chairman Jerome Powell says something not to... point is, scenario number 2, the one that you didn't expect is happening now, and you're stopped. I'm going to lose money on this trade. And no, but I was so right. I knew it's only because Jerome Powell said something. Maybe later on people will redigest that it's not that bad and the market will go back up. So what you do, you remove your stop loss. And what happens is, you are right. The market does go back up. It reaches your stop loss. Had you kept it there, you would have lost money. But instead, you're making money. Wow, you're such a good trader. But you know what? This is a negative reinforcer, because every single time the same scenario happens, the same, what you're going to do is you're going to remove that stop loss, saying to yourself, I'm sure I'm right. And you forget with time that a stop is there for a reason. The stop is making you become disciplined, because people are usually not disciplined. They need someone to, remind them of the discipline. We discussed that in a previous episode. So this is a negative reinforcer. So it will keep you doing that. It might work another time, a second time, a third time, a fourth time. It might work for as long as you want, until one day you will lose a lot of money. And what will happen? It will affect you psychologically. You will come back angry. You will lose more. And please, just take my advice on this. and just stick to your rules. And whenever you get stopped and you say to yourself later on, oh no, I got stopped, I lost money, but I was right on the trade, I could have made money. It's okay. Part of the business. It's okay. You have to accept it, be humble. Tomorrow is a new day, or the next trade is another trade, and move on. Accept it. And don't do the opposite. Remove your rules. Okay, so that's negative reinforcer. Let's go to the next slide. How can we go to the next slide? Okay, hold on a second. Just Joe asked another question. Move the stop loss regardless of the R&R ratio, so the risk to reward ratio. What do you mean, Joe? Move the stop loss regardless of the risk to reward ratio. Well, yeah. If you're talking about, your risk, you had a risk. Let's say, I don't know, 50 pips I was willing to lose, or I had a support level at some point, and then if it crosses it, full candlestick on an hourly chart, let's say, that's the way I would do it. Let's say, I'm giving an example, you would get stopped, but something happened in the market, there's a lot of volatility, and you think this is temporary and the market is going to, it's an uptrend. You're not fighting the market, everything's cool. So why am I getting stopped out? I'm not, stops. A lot of people, you're going to hear this a lot of times. Stops are for losers. Nobody makes this. If you're in a trade, it's going to make money, and then you don't put a stop loss. Well, you know what? Who is that smart? Who has every single trade positive? I don't believe that people can actually have every single trade positive unless they're holding through every single bad trade until it becomes, until it turns, the market turns in their favor. And that's the problem. Is it might work in a sideways market, for example, but it will not work as soon as the market changes. And if you don't learn to adapt to this change, you might lose so much money. So you can put another strict rule, let's say, for people who don't want to put stop loss, because I didn't put any stop losses for every single trade for my students. What I did was I put a daily stop loss or a weekly stop, okay? So it was a dollar amount and not based on support resistance. I would leave that to them. I didn't want to impose risk management on my students. I wanted them to learn how to do it themselves. Otherwise, what's the point if you don't understand risk management and you don't learn from mistakes and develop it? Risk management develops with what? Experience. It's not the day one that it starts. It develops with time. Okay, so we'll talk about this later. Okay, so beginner's luck. No, sorry, we're in another. Okay, so this is the slide. Can anybody see? Does everybody see the slide? Okay, let's just answer Joe's question again. Let's say you move your stop loss and your risk to reward becomes less than 1, for example. Does it still make sense to move it? Well, my point is never move it. And if you do move it, even regardless of your risk, you plan the trade ahead of the trade. So you're already in the trade. You can't now change your own rules, right? You can't move things around. You can move the profit around. You can move the trailing stop is something that goes up with your trade, so it locks profits. But in my example, I was talking about the stop when you're losing money, right? You're down $1,000 on the trade, and you say, okay, this is the maximum loss. I'm not going to lose more than 1,000. But then, you see that the market is getting close to your $1,000 loss, and then you decide to remove the stop. That's what I'm trading about, and then that's what I'm talking about. And then the loss now is not 1,000, it's 2,000, right? Oh no, you're frustrated more. But then the market turns, and now you're in the money. You're making $1,000. You get out. You're happy. Yes, I made it. I didn't lose that $2,000 or that $1,000. That's what I'm talking about. That's a negative reinforcer, because it will teach you to do this every single time going forward. And if you do this every single time, the next time, the time will come when it won't be 2,000, it won't be 3,000, it won't be 10,000. It would be so much that it will affect your psychology. You will lose. And I'll give you the story. This is a slide. Let's move on. So in this slide, you see this man. This man is Jesse Livermore. Long time. That's why the image is in black and white. But staying humble is extremely important, in my opinion. You should never underestimate the power of the market. Okay. never underestimate the power of the market. First, before we go through Jesse Livermore's story, I'm going to tell you his story. But I also remember the story about an IPO last week. You know, Snowflake. Just to go back to the sometimes things seem illogic, right? But you have to understand that the market is always right. So you know, the Snowflake is a cloud data warehousing company. Okay, so they got listed on the New York Stock Exchange last week, right? An IPO, initial public offering. The company's stock was valued at $70 per share. But on IPO day, the first day the company was trading on the market, the stock opened at $240. That was last week. Okay, and I tweeted a few things about it. That wow, $240 from a $70 valuation. And what happened? It did an intraday high of $319. And so later that night on CNBC, they asked the CEO, how come a company valued at almost $7 billion, market cap, is now trading at a valuation of $70 billion, 10 times more? Okay, and what did the CEO answer? He answered, a company is worth what investors are willing to pay for it. A company is worth what investors are willing to pay for it. So guys, it doesn't matter what I think, what you think. Imagine I have this experience. I know that the market is always right, that a company is worth what people are willing to pay for it. So it's not what I think it should be worth, right? Yet I made a comment and I tweeted it, that what is happening to the market? Why, is this happening? And I asked this question. Yet I'm telling you now, never ask this question. Just to explain to you that from this story, I want to tell you that even if his experience, large experience, and I still hear this every single day, experienced traders telling me, this doesn't make any sense. It's not supposed to go down or up. It's not so. Gold, why is gold below 1900? Inflation, We start blabbing and analyzing stuff. And that's why I told you in the beginning in a previous episode, don't over-analyze. Just analyze enough for you to understand why things are happening without going the extra mile of saying, yeah, but these are not logic. These don't make any sense. So again, guys, any financial instrument is worth what people are willing to pay for it, okay? The market is always right. So let's move on to Jesse Livermore. In Jesse Livermore's case, he knew the market is always right and it's powerful, but he took it lightly and it crushed him. So please take my advice and always remember that the market is always right, because this story is a sad story, okay? And I'll tell you the story, why traders should be humble, okay? Experience for one, as we said, but after a while, good traders realize that the market is bigger than they are. Once you think you have the market pegged and you have it all figured out, that's the beginning of the end. Once people, and I've seen this again, I'm going to tell you this a lot of time. I've seen this, I've seen that, I've seen this, I've seen that, but it's true. I've traded on a lot of floors in a lot of prop trading with different people, and so I made a lot of friends, trader friends, and I've seen people that were so good that I envied them, making millions of dollars annually, like kids 10 years younger than I was back then, and still they were making so much money. And of course, envy. It's unfortunately that's the way it is. I understood that they were good at something that I wasn't good at, but that's how I learned to be humble. Okay, Jesse Livermore was a trader who predicted the 1929 crash and made $1.4 billion in profit shorting the market during the crash. Okay, I don't know if you've seen the movie The Big Short. So similar to that situation, but The Big Short happened in 2008, 2009. The guy who predicted the mortgage bubble and made a lot of money off of it. Okay, I don't know what happened to him now. But this guy, Jesse Livermore, made $1.4 billion. Can you imagine in 1920s making that much money? He became one of the 10 richest men in the world. Okay. And 5 years later, he filed for bankruptcy. Okay, he predicted the crash, made so much money, and 5 years later, he filed for bankruptcy. So what happened? The market in 1929 and the years following was a period of total inconsistency and nothing made any sense. Livermore lost 40% of his profits the next year. So after he made the money, the next year he was, a king, but he lost 40%. What happens? anger, of course. So the next year, by going long the stock market, because he thought, okay, during the crash, oh, it's so low, it can't go any lower than that. The market is, so undervalued. Some stocks are so undervalued, especially the S&P 500. So he started going long in the next year, and he lost 40%. And it, the market kept going lower for 3 years after 1929. So he was still holding to his long for more years. And 3 years later, Livermore, what happened? Livermore decided to switch from being long to deciding, oh, the market's always right, and I'm fighting it. I'm fighting the trend, and he went short just in time for the market to go back again and double. We've seen this. I don't know if you know what when I say this story, even though it's a long time ago, I remember the same thing happened to me several times. I was long. I was so sure of my long, but then, oh no, I fought it so long, and now my loss piled up. I'm going to flip. This is a short market. And as soon as I go short, the market starts going up. That's what's happening here in this story. So he probably couldn't control his anger, and he went long again, and the market fell back to the lows, because in 1933 it went back even lower than 1929, etc., etc. So you catch the drift. He was wiped out. Now, not only he lost everything, but he was also in debt $5 million to brokers that he owed because they gave him credit lines. So what do we learn from this story? My students always ask me, okay, first of all, never underestimate the power of the market. But second of all, what we learn, something very important that we just discussed, risk management. And a lot of my students, as I was saying, always ask me, why? Why do I set these daily losses or weekly losses that I was talking to you about instead of a stop loss? So I set a daily loss limit. So this person, depending on their performance, has this set up. And it's an algorithm. So it goes up with your performance or down with your negative performance, okay? So obviously I fund their prop trading account, so it's not their money. So I want to set my own rules, right? So I do that. And they ask me, why do you do that? So it's limiting our potential. It's something that will cut them off once they reach a certain level of loss, okay? More importantly, I set it because I don't want them to reach. I do it also for a loss from top. So let's say they're up money on the week, but then they start losing. And as soon as they reach a certain level of loss from top, the same thing happens. They are cut off, okay, or shut down. And what I mean is, why I do it is because once they reach this loss from top, what happens? Anger surfaces. They want to make back the money. Let's say you're up for the week, I don't know, $5,000. Now you're only up $1,000, and I'm going to cut you off. So you're so angry, etc. What happens? You're going to probably end up negative. There's a high probability that trust me, that you're going to lose that 1,000 instead of keeping it. So yes, you're crying on the 5,000 that you had a week earlier, but now you should be happy that you're up only 1,000. But people, unfortunately, will not be happy with it and will do something called revenge trading. And this easily can switch anybody from being a risk manager to being a gambler. And this is deadly. You need to fall back on basic rules, take some time off. That's why I cut people off. I need them to rethink, okay, what did I do wrong? Did I, not follow one of the rules? You have to maybe trade lower size, get your head right. Otherwise, you will lose everything. And just like Livermore happens. Okay, so all good traders are humble. The next slide. And Livermore should have been humble because Livermore made his first fortune trading before the 1929 crash in 1907. And that's how old this picture is. In 1907 to around 1915, he made $3 million. And also $3 million back then was a lot of money. It's still a lot of money now, right? So $3 million he made from 1907 to 1915 trading the market. However, he lost it all and declared bankruptcy for the first time. So that was his first declaration of bankruptcy in 1915. So he should have learned how quickly years of solid trading and, consistent trading can go up in smoke, okay? So during the bull market that surrounded World War I, after World War I, there was a bull market, and right before, during, also because of all the weapons that the companies were fabricating, etc. in the US. So during the bull market that surrounded World War I, Livermore was able to recoup his fortune and pay back all his creditors from the 1915 bankruptcy. So he paid back everything. He was good again. His family was good, but he realized that it took him 14 years of grinding to make back his money. Okay, and in 1929, what happened? He made 1.4 billion, something that he would have never thought of. 1.4 billion, because he predicted the crash. But once he made that 1.4 billion, what happens is he lost that humbleness. He forgot that it took him so long to, probably forgot, I don't know, I've never spoken to that, but he probably forgot that it took him years of making money the right way. And then you let your guard down. And this, I'm telling you this story because this happens all the time with small traders as well, beginner traders with only, $1,000 accounts, is they grind, and then they're up 1,100, okay? 1,100, you're up 10%. I always remember that. Don't think to yourself, I'm up $100. What am I going to do with $100? It won't even pay my lunch and cab ride home, and etc. Okay, don't think this way. You just made 10% in, let's say, a month. That's amazing. It's a numbers game, remember? So all you have to do now is up your ante. So now let's continue. You just made 10%. Stay humble. What happens is, and I've seen this before, $1,000 becomes 1,100. They're happy. Okay, they understand that this is very good, 10%. But then they predict something very good, maximizing profit. $1,000 becomes $5,000. Wow, what is this? This is so easy. I just turned $1,000 into 5,000 or 10,000, and I've seen it. I've seen a guy turn 10,000 into $680,000. A client of ours. $10,000 turned into $680,000 in a very strategic trading, not gambling. He wasn't really throwing just money away with using high leverage. No, it was strategic trading, building a position, and going with a trend of an instrument. This guy ended up losing it all, of course, and losing more. But anyways, that's my point, is that this is why I'm telling you this story. Ultimately, to be successful in markets, you have to manage risk better than Jesse Livermore. If not, you're in gambling and you're not trading. So that's what we learned from where are we again? I'm not getting used to this. Okay, so that's what we learned from being humble. Set hard rules, especially when you're using leverage. Learn from past mistakes. Good traders, they don't think of them as mistakes. They think of them as opportunities, because now I learned this is something new. I've never seen it before. It doesn't make any sense, makes sense. It doesn't matter because the market is always right, but I'm going to learn from it. Use efficient risk management. Never underestimate risk management. Extremely important. And when you're right, keep your head right. So when you make money, because this is and that's why I was telling you, making money in the beginning is extremely dangerous. Is worse than losing money, is because your head will go places. Okay. When I spoke to that person who made 680,000, and I told him, maybe you have to reduce your size, because then by the time he was up 680,000, now he was trading large size. Okay. He forgot that he was grinding to make that money using a very simple yet effective strategy. And now he decided to take a lot more risk. And I did a calculation for him. I told him, you're not taking risk proportionally to what you had before. So proportionally before, you were taking risk, very reasonable, approved risk, with the 10,000, maybe with 20,000, maybe with 100,000, maybe with 200,000. But then with 680,000, now you're taking risk as if you have 2 million or 3 million. And so I did this small calculation for him, and he says, what do you suggest? I told him, you know what? Remove some money off the table. Take some money out. And he says, no. You know what? My objective is to reach 1 million. As soon as I reach 1 million, I don't want to trade anymore. I'm going to stop. And this I've heard also so many times. As soon as I reach this, I'm going to stop. As soon as Jesse Livermore reached $1.4 billion and didn't stop. Why? Because probably he knew that he was maybe high leveraged back then. Obviously he was, because he owed $5 million after the bankruptcy to credit to brokers. Okay, so even if you're up money, stay humble. Very important. And keep your head right. And most importantly, the last thing I want to tell you is do not overtrade. Trading should be boring. Remember, we discussed this previously. Trading is 20% execution and 80% waiting. It's like fishing. It's like you're going fishing and you're waiting and waiting and waiting for that fish. If you catch a fish, you're lucky. If you don't, it doesn't matter. Tomorrow you'll try again. So some days you don't see any opportunities. There's nothing wrong with that. People were going to ask you, so did you did you have a good day today? Yes, I had a good day. Not productive, but it was a good day. I didn't lose any money, right? Because I didn't force any trades. I didn't force myself into the market if I didn't see any opportunities. So don't over trade. When it's too exciting, when there's adrenaline pumping, when your heart is beating at 1,000 an hour, there's something probably wrong that you're doing. Okay, so it shouldn't be exciting. I know it is exciting. Do we have time for another story, or? I don't think we have time for this story, so we'll say it next time. That trading should. I know it's sometimes exciting, but keep your head right. Okay. Thank you all for your attention. Let's go do some. That's why I wanted to keep some, maybe 5 minutes for some trading, just to get the. Okay, so am I sharing my screen or not? What am I doing? Share. They changed the dashboard. That's a webinar software, and so sorry about that. Too old for tech. Okay, am I doing it right? Am I sharing the right screen? What is that? That's MT4, right? That's okay. Okay, so that's all. This is demo account, so we can. This is someone's demo account, so accept terms and conditions. Okay, these are examples that we were previously going. Okay, let's first. What do we do first? Okay, today is Wednesday. Is it 5:30 yet? Yes, it is. It's almost 6. Sorry about that. It took some time. So let's do a quick one. Let's first of all look at what do we look at first? The economic calendar, correct. So let's look at that very quick. What do we have today? Today, September 23rd. We said it's almost 6 o'clock now. All right. So what do we have? Okay, this is just put the screen right. Okay, so guess what? We had the about 20 minutes ago, we had the crude oil inventory. The crude oil inventory was, yes, released. And what was it? Let's just refresh my screen. Crude oil inventory. Yes. So the expectations, well, previously last week was minus 4.4 about million barrels. The expectation was minus 2.32 million barrels, but the actual was negative 1.63 million barrels. So is this worth or better than expected? It's actually better than expected. I don't know why they put it in red here. I'm not sharing the screen on the economic calendar. Sorry about that. I should, maybe. Yes, let's share the screen. Okay, now I'm sharing my economic calendar. Correct or not? Not. Okay, so now I'm sharing the economic calendar. So here you see the actual was, it says a worse than expected result, but it's a better than expected result because they were expecting a draw of, actually, no, it is a worse than expected result. They were expecting a draw of 2 million, meaning a drop of 2 million in oil, which is good, but the expectations was minus 63, was minus 1.63. So what happened to the market? Let's look at a trading view chart of oil. Boom. That's the euro. Wow, the euro is going down very hard, right? It broke these support levels that we have drawn here. So that's not good. What is the next support level? I think it's about 16, 20, 25. Okay, so what happened about 15 minutes ago or 20 minutes ago, was it? Let's look at the hourly chart. And of course, the market goes up, okay? Oil goes up because it was better than expected. Now, it has to go up because it's better than expected. Not always. Sometimes it doesn't make any sense. But you know what? The market is always right. So anyways, not only did it, if we notice here the chart, not only did it go back up, but it's almost breaking a support level that I see here, right here. And I'll draw a line where I see, a resistance level. So this is an area here that it broke. There's another line maybe. Here. Okay, so this rectangle here is an area that is trying to break on an hourly chart. Okay, so if it breaks it and we have a full candlestick here, the next candle, so the next hour will determine if this is turning into a bull market. And if it is, then we're going all the way up to 41 at least, right? So is that a good trade if we go long? Let's go back to the MetaTrader 4 very quickly, if we can. What am I doing? Share screen. Boom, boom, boom. Okay, so is that a good thing? Again, here we also see on the 4-hour chart, I wasn't looking at the 4-hour chart, right? I tell you to look at the big picture. I didn't do that on TradingView. I'm trying to make it fast because I'm already over in my time. I don't want to keep you waiting. But on the 4-hour chart, this is the 200 moving average. And we can see here that the 200 moving average is where is it? Where are my prices? Is about 41.26, so that's good. So we might have a good trade, and we're not really fighting the trend, right? Because we're above the near-term moving average on the 4-hour chart. However, the big picture is we are on a downtrend unless we break that 200 moving average. But we can still make 100 pips going long and turn that position, and let's try that and turn that position. I think I like this trade. So not 100, not 100 pips. It's now at 40.50. So we can go long at 40.50. We'll buy one lot, so that's 1,000 barrels. And always, I always tell my students always to trade what they understand. So if you don't understand what crude oil inventory is, or how crude oil is stored, and what the difference between Brent and WTI is, if you don't understand these things, you should understand these things. If you don't, then don't trade an instrument you don't understand. Try to move to another instrument that you do understand. For example, let's say you like tech stocks, etc. Trade the Nasdaq Comp Index, which is a composite index that includes 100 top Nasdaq companies like Microsoft, Netflix, Apple, companies that you understand. It also includes. It's not a tech index, by the way. A lot of people confuse the Nasdaq, say this is a tech index. No, it's not. It includes also pharmaceutical companies. It includes foods and beverage companies like Kraft Heinz, Starbucks, coffee. So there's a lot of companies that you wouldn't think are in the Nasdaq Comp 100 index, but they are. So it's not necessarily a tech index, but it has a lot of weight on tech stocks. And so let's, should we put a limit order or a market order? Does anybody has a First of all, does everybody approve that this is a long here and not a short? Well, it's not a long if it hasn't if it hasn't breached on an hourly chart. We just said that, right? The resistance level we drew. So it's not. So there is a high probability that it does breach it because of the fundamental, the catalyst, that we have better than expected results in terms of inventory, but it's not really a good thing, because we have to also take other factors in like the economy, how are other things doing, like stock indices, because oil is also dependent on the economy at whole. Is there any other figures today that are due? Yes, there is the PMI. Okay, this will also maybe change things, the US manufacturing and services PMI. Anyways, let's go long anyway, and we'll see that next time we meet, or I'll put it on my social media accounts. We'll put the results. So let's decide. This is a demo account. That's why we're not. You see, we're just throwing virtual money away, and so we're testing things. But I just wanted to showcase to you how it's done step by step. I'm now doing it a bit fast. I should do some more research and look at technicals much more in depth. But we're short on time, so we're going to go long here. Okay, so now we're long one lot, 1,000 barrels of crude oil WTI, so West Texas, at 40.45, and we're going to put we said take profit at 41. We said 41.25. Okay, that's the 200 moving average on the 4-hour chart. Okay, so that's done. So now we have to put a stop loss. Obviously, a stop loss has to be very tight, because if it drops, it means that on the next hour it did not breach that resistance level that we were looking at on TradingView, right? So we have to draw we have to put a stop loss right below that. The low of this candle on the right. Do you want me to share the screen again? Share the screen again very fast. Sorry about that. Because I see someone who's asking questions. Yes, thank you, Kareem, for the. Kareem, maybe you should take over. You're better than me with all these tech things next time, right? Trade with Kareem. Kareem's a good trader, by the way. Share screen. Oil. Okay, so here we go again. So we're breaching that. Okay, actually, look, it's now started. The next hour is starting now. So yes. Oh, okay, Kareem, that's what you're referring to. Okay, so 40 minutes until this hour is finished. A little bit more, actually, but it doesn't matter. As soon as it's done, and it looks like now it's going back down, right? So yeah, we're losing money now on the trade. Okay, so it looks like it's going back down. So we have to put the stop loss right below it, which is below $40. But do I like that? We're making 75 pips, and we're probably going to lose also 75 pips if we put it below $40. So let's put it at 39.90. Okay, so let's put our stop at about 60 points lower. So that's our scenario. 60 points lower stop. Here you go. So we are going to put a stop here at, we said, 39.90. Boom. Okay, process. So our stop is at 39.90. Our take profit at 41.25. But most importantly, we're going to put another trade that if it reaches the 200 moving average on the 4-hour chart, we want to go short. So the market execution will be changed to pending. We will put a sell limit and the sell limit will be at 41.25. So we're getting out of the position and getting back short. We're flipping. Karim loves that flip. He calls it flip and lip. So 41.25, and we will put a stop loss obviously for this one as well. So it's a 4-hour chart. I see here that there is I don't know if you see it also, there is a wick here, and it's at, what price is it at? I don't have all my prices here. Something wrong with my software chart. I see my prices here. Okay, I'll fix that later. So it's at around 41.70. So we'll put it at 41.75. That's 50 pips. 41.75. That's 50 pips. And the big picture is the trend. We believe it's still down unless it breaks that, which means it's a higher high. Sorry, it's a lower high than the previous high, and we don't want this to break. So 41.75, and the take profit it's a downtrend. So we're taking 50 pips loss. So let's do 2-to-1 ratio. So that's 40.25. Right? 50 pips, 100 pips. Place. That's it. Okay, guys, let's look at this for we're not going to look at it for today because obviously nothing is going to happen today, I don't think, anyways. But if it does, I'll let you know all over social media, and we will discuss this, on the chat, on Telegram, etc. Whoa. Disable screen sharing. Okay, that's all, folks. Thank you a lot for your attention. Thanks for this finale. Let's call it the finale of our series of 10 webinars. I'm sure I'm going to meet you again, hopefully soon, virtually or face-to-face. Don't forget, fund your account with Squared Financial, because at least you have this added value. We are here to help you succeed. We are here to coach you and try to figure out how to help you the best we can. And please, we have another idea. We came up with another idea that in order to help you guys, is that when you open your real account, share with us the read-only password. Even if you fund it with a very small amount, $100, doesn't matter, because you're in the learning process. And I always recommend that you fund it with the smallest amount possible. We discussed this before. Don't trade money. Don't trade your rent money or food money or stuff. Trade money that you can afford to lose, especially in the beginning. Why is this flu? Okay. And I'm sorry about that. And yes, so share with us your read-only password. We'll monitor and we will help you as much as we can, and make sure that you become successful. Okay, yes, Joe, oil has been such a mess. It is, but not going long oil until the end of COVID. Yes, you're talking long term. We just want to do a trade and then analyze the aftermath. It's the wrong way, I know. We should analyze pre-trade, plan the trade, remember, but we're doing this from a learning perspective. So we're doing this, and then we will analyze what happened or what should have happened, etc., in order for us to understand better how markets function and how trading is, of course, maybe I shouldn't have traded oil now, just like as you said, sometimes not trading is also a good thing. However, I will share with you the results later on. Thank you. If you don't have any more questions, thank you for listening, and have a nice evening.